the strike price of 45. Again, not all of the strike prices for SMH options are listed on the table. So the option chain listed here includes 11 call option contracts and 11 put option contracts, all of which expire in January. Most option chains are sorted in this manner and include a list of all expiration dates and strike prices for that index or exchange-traded fund. Each column within the table provides a different piece of information. On each side of the table call and put, the first row lists the options symbol. For example, on the left half of the table, the third row from the bottom shows the January 40 call, which has the ticker symbol SMHAH. SMH is the root symbol for the semiconductor HOLDRS options. A represents the month of January, and H represents the strike price. As with stocks, options have a bid price and an asking price, which appear in columns 2 and 3. The bid is the current price at which the market will buy the option and the ask is the price at which the market will sell the contract. Since this table is delayed and not real-time, we would not necessarily use this bid and offer as a guide when entering orders. Instead, we would want live data, which is usually available through the broker placing the order. The final column indicates the option's open interest. Open interest is the total number of contracts that have been opened and not yet closed out. For instance, if an option trader buys, as an initial transaction, the 5th of February 65 calls, the open interest on that call will increase by 5. When the trader later sells those 5 calls to close the transaction, open interest will decrease by 5. Generally, the more open interest, the greater the trading activity associated with that particular option and, hence, the better the liquidity. Open interest is only updated once a day. The information included in an option chain will differ somewhat depending on the source, but the variables described earlier are the most common. In addition, many brokerage firms offer option chains with real-time quotes. As the options trade, each row will blink as the last price is updated, or when the bid and offer change. In this way, it becomes easy to view the price movement of a variety of different contracts simultaneously, which can help the trader sort through and identify the option contract with the most appropriate strike, expiration month, and market price for any specific strategy. A note about risk graphs: since options are derivatives, their values will depend on the price of another asset. For example, the prices of put and call options on the S&P 500 index $SPX are derived from the value of the S&P 500 index. In this case, the index is considered the underlying asset. As its value changes, so will the value of the options. For that reason, many option strategists like to consider what will happen to the value of their options under different scenarios, in other words, assuming price changes in the underlying asset. There are two primary ways option strategists can view the outcome of a given option strategy assuming price changes in the underlying stock. The first method is to create a table. For example, Table 4.5 considers call options on the semiconductor HOLDRS SMH. In this example, the SMH is the underlying asset. At the time of this example, shares of the fund are trading near $35, and one December 35 call can be purchased for $1.25 or $125 per contract. Table 4.5 was created in order to see the risk and reward of holding the SMH December 35 calls. The prices are those that can exist at expiration. Understanding options 69 Table 4.5 Potential profit and loss from SMH December 35 call purchase SMH at expiration Dec 35 call at expiration profit loss intrinsic value $30 $0 $125 32.50 $0.00 $125 35.00 $0.00 $125 37.50 $2.50 $125.00 $40.00 $5 $375.00 70. The index trading course. Or at close of business on the third Friday in December. Notice that if the stock falls below $35 a share, the position loses $125. In other words, the option expires worthless below $35 a share and yields no profit. On the other hand, if the stock climbs to $37.50, the options are worth $2.50 and the profit totals $1.25 per contract, or $125. At $40 per share, the profit equals $375, $5 minus $1.25 equals $3.75, multiplied by 100 shares. Notice that the position breaks even at $36.25 because the call is worth $1.25, or equal to the initial cost when purchased. A second way to see the potential profit or loss from an option trade is with a risk graph, which plots the profit from the option on one axis along with the price of the stock on the other axis. Figure 4.2 is an example of a risk graph using the same SMH December 35 call with the fund trading near $35.11 a share and 43 days left until expiration. The cost of the option is $1.25 per contract, or $125. The potential profit from being long this call is plotted along the horizontal axis and the price of the stock is on the vertical axis. The chart was created using Optionetics.com Platinum, and we use many of these charts throughout this book. Notice the line that is the farthest to the left. It plots the same information as the table. In other words, that line considers the potential profit and loss of the SMH December 35 call at expiration. Just as we saw on the table, the profits begin to accrue when SMH reaches. Figure 4.2 SMH price chart and risk graph for SMH December 35 call option. Source: www.optionetics.com Platinum. $36.25 a share. In other words, at expiration, $36.25 is the break-even, or the point where the trade yields no profit or loss excluding commissions. A vertical line is drawn at 0 on the risk graph to mark the break-even point. Notice that prior to the stock reaching $36.25, the profit black line is to the left of 0 and the position is showing a loss. Unlike the table, the risk graph in this example also considers time frames prior to expiration. The other lines, which appear as different colors when looking at a computer monitor, show the risk-reward with various days left until expiration. The one that is the farthest to the right shows the profit and loss in the call option with 52 days until expiration, the farthest to the left shows the call at expiration. Risk graphs are helpful because they give the option strategist a better idea of the profit and loss potential, not just at expiration, but also as the option premium loses time value. In addition, risk graphs are simple and convenient because they can be created quickly and easily using Optionetics.com Platinum or other options trading software. Finally, risk graphs are not limited to simple calls and puts but can also be created for more complex strategies such as spreads and straddles. Doing so provides the options trader with a quick visual presentation of the profit and loss potential of any option strategy, which can save a substantial amount of time when screening for the next potential winning trade. Conclusion: strategists have two vehicles from which to choose when trading the index market. 1. Shares of exchange-traded funds, or 2. Options on the underlying index or exchange-traded fund. The options contracts are similar to stock options. They come in two types: puts and calls. Finding quotes, creating options chains, and developing risk graphs are the same for both stocks and indexes. Index options, however, also have unique characteristics that make them different from stock options. Before developing strategies on the index market, traders want to ask a series of questions including the following: does this product settle for cash or shares? Is the last day to trade the option on a Thursday or a Friday? Do these options settle American or European style? If uncertain, strategists can obtain product specification information from the various websites where the index options trade. Please see Chapter 15 for a list of index website addresses. Understanding Options 71. 73. Chapter 5 Basic Strategies Using Call Options. A large number of options strategies have been covered in detail in our 3 previously published books: the Stock Market Course, the Options Course, and the Volatility Course. In order to prevent too much repetition, this book does not provide an overview of all options strategies. Instead, we prefer to focus on identifying profit-making opportunities in the index market using trading strategies such as market timing, sector rotation, and system trading. All of these important issues are discussed in greater detail in later chapters. For now, we continue the foundational task of building a knowledge base, beginning with a discussion about basic options strategies. Readers who already understand strategies such as long calls, covered calls, and vertical spreads are encouraged to skim through this chapter and move on to the next. However, since options are used extensively throughout later chapters, a thorough understanding of these basic strategies is a must. Long call. We have already introduced the basics of options trading, including the most fundamental strategy, the long call. The term long is used often and simply means that the trader is holding a position. For example, if a trader is long 100 shares of SMH, he or she has purchased and is holding shares of the semiconductor HOLDRs in hope that the price will move higher. On the other hand, a short position is one where the trader borrows shares. 74. The Index Trading Course. from the brokerage to short sell, in the belief that the asset will decline in price. In the strategies used here, traders can be long or short shares, puts, or call options. So, as the term implies, a long call is simply buying and holding a call option. We saw this trade in our discussion about risk graphs in the previous chapter. Specifically, we analyzed the semiconductor HOLDRs trading near $35 a share and assumed that a trader purchased one December 35 call for $1.25 a contract. So the total premium is $125 for one contract, which gives the owner the right to buy, call, 100 shares of the SMH for $35 per share. To compute the break-even, the cost of the option contract, the premium, is added to the strike price of the call. In this case, the break-even is $36.25, $35 plus $1.25. Traders will often exit the long call strategy before expiration if the underlying asset moves dramatically higher or lower. If it jumps higher, the call can be sold at a profit in most cases, although time decay and volatility will also affect the premium. If the underlying asset falls in price, the long call position can be closed at a loss. If it falls below the strike price and is not sold, it expires worthless. The long and short of it. Long, a term used to describe an ownership position in a stock, option, or other investment. Being long shares and calls is a bullish strategy that profits when the price of the asset moves higher. Being long puts profits in a bearish market when the price of the underlying asset moves lower. Short, a term used to describe the selling of a stock, option, or other investment. Stocks are best sold short in bearish markets when the share price moves lower. Selling a call is a bearish strategy while selling a put is a bullish one. When selling stock, a short seller borrows shares from the broker and sells them at the current market price. The shares are eventually bought back and returned to the broker. Investors can also short puts and calls. However, options contracts are not borrowed from the broker. Instead, a short put or call can be established at any time, if the broker allows this type of strategy. In some cases, the broker will not allow short selling of options because of the risks involved. When do long calls make sense? Since the premium is relatively small compared to the price of the underlying asset itself, the trade is relatively inexpensive. Therefore, call buyers are often speculators betting on a move higher in a stock, index, or exchange-traded fund. Basically, the long call provides a low-cost way of profiting from a move higher in the underlying asset. In sum, the strategy works well when the strategist expects. 75. Basic strategies using call options. The underlying asset to move higher and wants some leverage. It is an aggressive trade. For example, suppose the strategist expects chip stocks to make a run toward the end of the year. In 2003 and 2004, the technology sector did well during November and December. Consequently, during mid-October, the strategist makes an aggressive play by purchasing the December 35 calls on the semiconductor HOLDRs. The SMH is trading near $35 a share at the time. The calls cost $1.25 a contract. The risk graph of the SMH December 35 call was explained in the previous chapter. We see it again in Figure 5.1. The risk graph gives us a visual display of the profit-loss potential of the trade. For example, the cost of the trade is the entry debit of $125, which is the premium $1.25 times the multiplier 100. Since the trade was just established, the profit is zero, the option has not increased or decreased in value. The potential profit is unlimited, however, and will rise along with the price of the SMH. For example, if the SMH rises to $70, unlikely but possible, before expiration, the value of the December 35 call will rise to $35 per contract, or $3,500, plus any remaining time value. Therefore, the long call has relatively low risk equal to the premium paid, but high profit potential. The long call can be used to profit from a rise in the underlying ETF or index. When using this approach, the strategist faces several important. Figure 5.1 SMH December long call risk graph. Source: www.optionetics.com. Platinum. 76. The Index Trading Course. Questions. These include which option strike price and expiration dates are best when looking to profit from a move higher in the underlying asset. Out-of-the-money strike prices provide greater leverage because the premiums are smaller, but they also have a greater chance of expiring out of the money. Short-term options will see a faster rate of time decay and therefore are better used when the expected holding period is short. Given these considerations, the strategist will use short-term at-the-money or out-of-the-money options when bullish and looking for an aggressive move higher. Longer-term and in-the-money options are better when looking longer-term and expecting a more moderate move higher. The exit strategy is also important. In fact, the success of any trade requires an understanding of not just when to buy but also when to sell. Often overlooked by new traders, the exit is just as important as the entry. The long call strategist may be looking for a percentage gain as large as 50 or 100%, which is not unusual, but the key, of course, is timing. This subject is discussed in greater detail later in the book. Putting the question of timing aside for now, call options with a few weeks of life remaining will see a relatively fast rate of time decay, particularly for at-the-money options. Given this characteristic, the long call should generally be closed out well before expiration due to the negative impact of time decay. For that reason, we often suggest exiting any long call position at least 30 days prior to expiration. The worst-case scenario for a long call trade is that the stop price falls and the call option expires worthless. Therefore, the strategist will often establish a maximum loss threshold for exiting the trade. For instance, if the call loses more than 25% of its value, close the trade. A second approach would be to exit the option position if SMH falls below $34.50 a share. These specific exit points are called stop losses. On the other hand, if the stock price moves higher, the strategist can exercise the option or close it at a profit. In most cases, the call will be closed out through an offsetting trade rather than exercised. Exercise generally doesn't make sense unless there is no time value remaining in the option and the strategist specifically wants to be long the shares. Opening and closing transactions. An opening transaction occurs when an option strategist initiates a position. For instance, if a trader buys 10 QQQQ calls in anticipation of a move higher in the Qs, it is an opening transaction. An offsetting or closing transaction cancels an open position. It is accomplished by doing the opposite of the opening transaction. For example, the short call in a short call trade, the strategist is selling call options to establish a position. It is a bearish strategy because it works best when the price of the underlying asset is expected to fall. However, if the strategist sells an out-of-the-money call, the trade can yield profits even if the underlying asset price stays flat or moves higher. As long as the short call expires worthless, the call writer is generally okay. However, the risk to the short call is that the underlying asset moves to the upside. If the price of the underlying asset makes a big move higher, the call writer can run into trouble. In fact, there is no limit to the potential losses from a short call because, theoretically, there is no limit as to how high the price of an asset can climb. Let's consider an example. The strategist expects the market to trade flat or modestly lower during the final 2 months of the year. To capitalize on this expectation, a short call is established in early November on the SPDR's SPY, which is trading near $121 a share. The strategist sells 10 of the SPY 125 December 2005 calls for 70 cents a contract. The sale brings in premium of $700, 70 cents times 10 contracts times 100, which the strategist will keep as long as the SPY stays below $125 by December 2005 expiration. Figure 5.2 shows the risk profile of the short call position. Notice how the profit-loss lines slant upward and to the left. The line furthest to the right represents the risk at expiration. It confirms that if the SPY stays below $125 a share, the strategist can keep the entire credit of $700. However, once the SPDRs climb above $125, the curve begins to slant in. The trade breaks even at $125.70, while the short calls are likely assigned at $125 and higher. To avoid possible assignment, the strategist can purchase the calls back at approximately 70 cents to offset the position prior to expiration. As an alternate approach, the strategist can buy the shares for $125.70 to satisfy assignment. However, these shares are then assigned basic strategies using call options. 77 Opening and closing transactions continued. If the trader wants to cancel the long 10 QQQQ calls, 10 QQQQ calls will be sold to close. There are 4 ways to offset an option transaction. 1. If you bought a call, you have to sell a call. 2. If you sold a call, you have to buy a call. 3. If you bought a put, you have to sell a put. 4. If you sold a put, you have to buy a put. 78. The Index Trading Course. Figure 5.2 SPY December Short Call Risk Graph. Source: www.optionetics.com Platinum. Sold for $125 and the transaction realizes a 70 cents per share loss. Since selling 10 calls is a commitment to sell 1,000 shares, the assignment results in a $700 loss, the premium received for selling the 10 SPY December 125 calls. In short, the break-even is equal to the strike price plus the premium received from the short call. The losses begin to pile up as shares rise above $125.70. The call's potential loss is unlimited. Losses continue to increase as the price of the underlying asset rises above the break-even, and there is theoretically no limit to how high it can go. Therefore, given the risks involved, the short call is not a recommended strategy for private investors. It is generally less risky when applied to the index market than to stocks because an exchange-traded fund or an index is less likely to experience a one-day surge that might sometimes take shares of an individual company higher. For instance, imagine selling calls on Google when it started trading in August 2004, only to see it double from $100 to $200 a share in the months that followed. Say a trader sold the October 100 calls for $8 a contract, assuming the stock would fall shortly after the company's IPO, and then waited until October expiration to cover. Less than 2 months later, those same calls were trading for $44 a contract. Therefore, the strategist would be buying back the contracts for a $36 loss, or $3,600 per contract. Obviously, selling naked calls can be a tough way to make a living. An index is not likely to make such a dramatic move. Nevertheless, the losses from a naked call gone awry can be significant, especially when dealing with the large cash settlement indexes such as the S&P 500 index or the Nasdaq 100 index. So instead of using naked calls, strategists who want to sell premium in a down market might want to focus on an option spread strategy, such as the bear call spread. Bear call spreads traders who sell options receive credits into their trading accounts equal to the premium of the options. In the Google example, the premium for selling the October 100 call was $8, or $800 per contract. Selling options may be used to generate income from a portfolio, however, as we have noted, the risks can be great. The bear call spread is a vertical credit spread strategy that profits from selling options, but with significantly less risk than naked option selling. A bear call spread consists of selling a lower strike call and buying a higher strike call using the same number of options and identical expiration dates. The trade works when the underlying asset closes below the strike of the short option. Therefore, a bear call spread works when the strategist is bearish or neutral on the underlying asset. The bear call spread offers limited profit potential with limited risk. The maximum reward is achieved when the closing price of the underlying security is below the lower strike call. In that case, both calls expire worthless and the strategist can keep the credit from the trade. The maximum risk is equal to the difference between strike prices minus the net credit, and occurs when the price of the underlying asset closes at or above the strike price of the long option. To see how the bear call spread works in the real world, let's consider an example using the Amex Airline Index $XAL. It's late November and the airline sector has been strong, but the strategist expects the group to hit some turbulence early next year. With the airline index trading near 51, the strategist sells the January 50 call for $4 and hedges that bet with the purchase of a January 60 call for 25 cents a contract. So the bear call spread consists of a short January 50 call and a long January 60 call. Figure 5.3 shows the risk graph of the bear call spread on the Amex Airline Index. The profit potential is limited and occurs if the airline index loses altitude before the options expire. The maximum profit is equal to the premium received for selling the XAL January 50 call minus the premium paid for the long call, or $375 per contract, $4 minus 25 cents times 100. The maximum profit is therefore $375 and occurs if the XAL falls below 50 at expiration. Basic strategies using call options 79. 80. The index trading course. Figure 5.3 XAL January bear call spread risk graph source, www.optionetics.com Platinum. Losses begin to occur if airlines begin to drift northward. The break-even is equal to the strike price of the short call plus the net premium received for selling the spread, $50 plus $3.75 equals $53.75. Beyond that price, the spread will begin to lose money as expiration approaches. For instance, if the value of the XAL is 55 at expiration, the trade will lose $1.25 per spread. However, the long call will cap the losses once the XAL reaches $60. At this point, if the short call is assigned at 50, the long call can be used to satisfy assignment. In that case, the strategist will be assigned at 50 per share and can exercise the XAL January 60 call, resulting in a $1,000 loss per spread. However, the strategist also keeps the $375 premium from selling the spread. Therefore, the maximum loss is $625, $1,000 minus $375, and occurs if XAL is 60 or greater at expiration. Hence, the maximum loss from the bear call spread is computed as the difference between the two strike prices minus the net credit. The example shows that the risk graph of a bear call spread slants up and to the left due to the fact that it loses money as the underlying asset moves higher in price. It is similar to the short call, but with one important difference: the long call caps the potential losses for the trade. However, the farther out of the money the long call is, the greater the risk of the trade. For example, a deep OTM call might be used when the strategist is looking for disaster insurance, but a more conservative bear call spread can be established by using two calls with strike prices a bit. 81. Basic strategies using call options. Closer together. In the airline example, the strategist could limit the risk even further by purchasing the XAL January 55 call instead of the January 60 call. However, that would also reduce the credit received from the bear call spread. Finding the right spread is a balancing act. The exit strategy for the bear call spread is straightforward if the index does indeed move lower. If the underlying index falls to the price of the short call, the bear call spread reaches its maximum profit potential. At this point, the strategist can't do anything but simply let the options expire worthless and keep the initial credit. Conversely, if the price of the underlying shares rises to the strike price of the long call, the maximum loss occurs. Generally speaking, the strategist should close out the spread well before expiration if it appears that the original forecast and direction of the underlying prove incorrect. Again, establishing stop-loss targets is one way to determine if and when to bail out of a bear call spread. For instance, using the previous example, if the XAL rises above 55, the strategist might